Let us take another example. A, B and C are partners sharing profits and losses in the ratio 2:2:1. Balance sheet is given. A, B, C's capital accounts. There is a general reserve, outstanding expense and sundry creditors. Land and building, furniture, stock, debtors, bank and cash. Partners have decided to take D on 1st April on the following terms. D brings 10,000 capital, stock increases by 5,000, furniture is depreciated by 10%, there is a provision for bad debts 10%. Goodwill is valued at 15,000 and new ratio is 2:2:1:1. Which means that the profit sharing ratio among the old partners remains the same. 2:2:1, it was 2:2:1. Outstanding liabilities have been paid by A and entry has not been passed in the books. So D is admitted. What are the things that we will do? We know the new profit sharing ratio. We will check for goodwill is valued at 15,000. Goodwill valued at 15,000, what do? Goodwill account debit to old partner's capital account and then write it off in the new partner's capital account. But normally what we do not raise goodwill unless cash has been paid for it. Therefore, goodwill valued at 15,000, what would be the entry? One by one we will take what profit sharing ratio given, then we will do goodwill, we will do revaluation and we will do transfer of accumulated profit. What is the entry for goodwill? New partner is D, coming in for 2 + 2, 4, 5, 6, 1/6 share. D's capital account is debited with his share of profit. So D account debit with his share of goodwill, that is 1/6 of 15,000. 2,500 to A, to B, to C in the sacrificing ratio, which is 2:2:1. That is 1,000, 1,500. Next entry for revaluation.
We have a quiz after this. So after this, probably want to take a break. Then we'll take
Next, we check entries for revaluation of assets. There is a stock increase of 5,000, decrease in furniture, provision for doubtful debt. So there are 3 adjustments. This is positive. These 2 are reduction in the value. If we look at the net profit, we could do that. What has happened? Increase in stock 5,000. Profit. Loss is depreciated by 1,000. 10% of 10,000. And provision for bad debts is 10%. 10% of 6,000 is 600. Therefore, what is our net profit on revaluation? It is 5,000 minus 1,600 or 3,400. This is the profit on revaluation, which should go to A, B and C in their old ratio 2:2:1. Assuming no revaluation is being, we've made the solution, no? And we've done it by increasing the value of asset, no? So I have to pass the entry anyway, no? You'll note all these breaks, you're not right. Entry would be stock debit 5,000 to revaluation. Next is furniture reduction in value. So revaluation account debit to furniture. Oh, sorry. Revaluation account to furniture is 1,000 and to provision for doubtful debts would be 600. So revaluation account debit 600. Profit on revaluation 3,400. So revaluation account debit 3,400 to A, to B, to C. One three six zero, 1360, and 680. So we have taken care of goodwill, we have taken care of assets and liabilities, revaluation of assets and liabilities. Next is general reserve account debit to A, B, and C, 8,000, 2:2:1. 3,200, 3,200, and 1,600. So we have passed entry for goodwill, we have passed entry for revaluation, we have passed entry for accumulated profits, and D brings in 10,000 as capital. That is one more entry, cash account debit or bank account debit as the case may be, to D's capital account, amount of 10,000. There's one more entry where outstanding liabilities have been paid by A. The entry would be outstanding expenses account debit to A. To A. Why? Because A has paid the money. Therefore, A's capital account is credited. 7,000. This takes care of all the entries required on the admission of D. Revaluation account by stock to furniture to provision for doubtful debts. So we had 3,400 as the profit. Partners capital accounts balance has been brought down and D has brought in 10,000. Revaluation as we did, it came from here. Outstanding expenses were paid by A. General reserve was transferred. What else did we do? For goodwill. This is for goodwill. What was the entry for goodwill? A's account was credited by 1,000, B's 1,000 and C's 500 and D's was debited with 2,500 being his share in the goodwill of 15,000. So these are the closing balances. Balance sheet, land and building, furniture. Furniture, there is a change in the value, it's come down by 1,000. Stock has increased by 5,000. Debtors less provision, cash balance, bank balance and cash balance. D had brought in a capital of 10,000. So it has increased to 15,000. A, B, C, D's capital accounts as per Capital account prepared here and creditors of 15,000. There was an outstanding liabilities which is no longer